Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist. Taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC-registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
Hi, everyone. Welcome to episode 151 of Facts versus Feelings. Ryan and Sonu. Sonu, September blues. The time we're recording, the stocks are down. I don't know. Maybe we should have called it Red September, but we'll see where it goes. Obviously, last week we had Cliff on, Cliff Asness, over from AQR, founder over at AQR. Amazing discussion. So we've got a lot to talk about more real time. So let's just kind of dive into it. We don't need to spend a ton of time because it almost feels like old news. But Jackson Hole sparked an incredible rally to end the normally weak month of August. We'll talk a little bit about the strength of the bull market and different things, but high level, you've had a lot of time to think about it now. Just how dovish was Jackson Hole, you think?
It's very dovish. I mean, because if you just look at because there's always like, okay, what did they say and how did markets react, right?
Exactly.
And it's always nice to pay attention to how did markets react. And especially once you've had 3 week to 3 days, 1 week to sleep on it. Look at the Russell 2000 index, right? The small caps, they've been on fire. And I think that gets to the fact that Powell is dovish at Jackson Hole. Basically, he said, look, the risks to inflation, they've got two sides to their mandate, right? Stable inflation and maximum
employment. Let me jump in. So literally, I'm holding it up. You can't see it, I know. It's my vet calling. And I'm sure it's going to we've joked before about veterinarian costs. I can only imagine.
You're going to talk inflation too.
Yeah, my dog... my dog's nuts, so we give her medicine to calm her down, and that's, I think, a refill for that. So I'll let you know if that price went higher. Is it
magnesium or something like that? I feel like I need to I give my kids something to calm them down.
It's doggy Prozac, I think, is what it is. She's 120 pounds, just pure hyper and crazy and sweet girl. But anyway, there's my vet calling. So that's the inflation discussion. Go ahead. Sorry,
we'll get there. We'll get to pet services. But look, so Powell said, look, the risks to both sides of the mandate is rising. Right? In risk to inflation are tilted to the upside, is what he said, and risk to employment are tilted to the downside. And that's challenging, right? So which one do you pick? And but at the same time, this is, I think, what was important and just boils everything into a nutshell, right? Powell said, look, policy rates are right now in restrictive territory. Now, he doesn't think they're very restrictive, but he thinks it's restrictive. And that means, quote unquote, the shifting balance of risks may warrant adjusting a policy stance. I think everyone skipped over the word may. Yeah. And just say will warrant adjusting the policy stance. I'm not saying they won't cut. I just don't think it's a complete lock. It's not 100%. Markets are pricing a September cut at 87%. So, is it close to a done deal? Maybe, but I don't know. I think we still have to wait for the payroll data, which you're getting at the end of this week. Today we are recording September 2nd. September 5th is when we get the payroll data for August. If that shows that the labor market is holding up, I don't know that,
right?
A cut is baked in.
Which is kind of interesting because a month ago when we saw the huge downward revisions to previous months, and obviously President Trump wasn't very happy and fired the head of the BLS. And looking back, if he wants rate cuts, he probably should want some weakening labor market. I don't know if we want to tell him that, but that's kind of how that might be the easiest way for him to get rate cuts is with a weak number this coming Friday
from the administration. Look, I think if you look at Atlanta Fed GDP net, Q3 GDP, I'm not saying this is the correct thing. There's a lot more data to come. In fact, this morning we got manufacturing PMI that's going to feed into the Atlanta Fed GDP nowcast. That's going to pull it down. But right now it's running at 3.5%. Yeah. Now, 120 basis point, 1.2 percentage points of that is coming from exports and inventory. So that's a volatile part. Set that aside. But you're still take that away. 3.5 minus 1.2, you're at 2.3. Yeah. I mean, that's not guns blazing economy. But it's still below trend, but it's not. It's nowhere close to a recession.
So let's remember this: 100 trading days ago today. 100 days ago today, the day we're recording this on Tuesday, the 2nd of September, was the low in April. All right. And just again, markets don't, I've done this a long time. And one thing I'm pretty certain of, markets don't care about good or bad. They care about better or worse. 2.3% GDP growth right now doesn't sound all that great compared to the 3% we were seeing the last couple of years. But compared to 100 trading days ago, when every economist you saw on TV told you how bad it was going to be, predicting a recession, that's why we're flirting with, I know we're off a little bit off the highs, but still, we hit 5 new all-time highs in August for the S&P. Maybe a little rough September. We'll get to that. But those are some things to think about.
And the Fed's talking about cutting.
And the Fed,
that's the icing over here. And we'll come back to, we'll talk about Lisa Cook and
anything else on Jackson Hole? Because this feels like old news almost, but I know we wanted to touch on it to set the stage here. Anything else you wanted to talk about?
If Powell wanted to say they are going to cut rates explicitly, he would have. That's in fact what he did last year at Jackson Hole. He said the time has come for us to adjust policy, right? This year he said, yeah, conditions may warrant. I thought he was iffy about it. The market, of course, ran with it. But, I'll put it this way. The path ahead, as far as Powell is concerned, is very uncertain, right? This is what he said is not a signal that, you get a cut in September, and that means you're getting a cut in November, cut in December as well. Last year, that was not the case. The signaling of a September cut was a signal that, we're going to begin a series of rate cuts. This year, I don't think that's going to happen. But at the same time, if you look at what markets are pricing in for next year, the market is pricing in 4 cuts next year on top of 2 cuts this year. So 6 rate cuts by the end of 2026. That would take the Fed funds policy rate from its 4.4% now down to 3%. In fact, it's pricing in slightly below 3%. I mean, you were just talking about the fact that, the economy is not going gangbusters, but it's growing okay. And I don't think the labor market is as weak as everyone thinks it is. I'm not saying it's great, but I don't think it's really weak, right? And we are pricing in, forget September, we're pricing in 6 rate cuts between now and next year. Think of what that would do to housing, for example. Home equity loans. You and I have talked about the fact that, in markets, everyone talks about $6 trillion in money markets as dry powder.
I think it's 7 trillion. Who's counting?
I think the real dry powder is home equity. Because that's actually new money being created. If I take a home equity loan, that is new money being created by the bank that provides me the loan. That's new money in the system. That's new money for profits and the equity market, right? In a sense, that is the real dry powder that's sitting out there. Nobody can tap it right now because of high interest rates, but think of what happens when interest rates go down.
Yeah, think about what's leading this market right now. It is banks, right? We got a steepening yield curve. We'll talk about that. Banks love it. But I do want to point out, so we'll put this up on the YouTube channel right now. That reaction to the market on the Jackson Hole. So Jackson Hole happened, whatever. What'd the market say? Well, we had a 90 day, Sonu. That's what 90% of the stocks on the S&P, on the NYSE, New York Stock Exchange are higher, and 90% of the volume is higher. Again, on the YouTube channel, we're sharing this. Very, very rare. Only happened 12 other times, going back to 1980. And as you can see on the screen, higher a year later, 11 of them, up well over 20% average. And then, I know you like this, Sonu, because if you look at it, a lot of these were on policy shifts, like early 2019, Powell shifts to dovish. We had the fiscal cliff relief rally in early 2023, massive European bank recapitalization 2011. Fed announced time-based forward guidance. I have no idea what that even means, but that's in August 2011. IMF announced massive stimulus in 2010. Banks announced end to consumer credit issues in July of 2009. TARP, of course, is in there. Listen, the reality is the market's going to do what it wants to do, but sometimes you need a major driver. And I guess the reality and a catalyst. And, we can talk about maybe why September might have a hiccup or two. We'll get into that. But the reality is we're still quite optimistic here. And I think the reaction to Jackson Hole does little to change my opinion. Anything else you want to add there?
No, I think, David, you could put this chart up. Again, going back to the markets now expecting 6 cuts by 2026.
Yeah.
So here's what we have, right? I know our outlook is 10 to 15%. And looking at your charts, it looks like rest of the year, if May, June, July, August, I know you'll get into it. If that's positive, you're looking at a median return, 3-4%, something like that for the rest of the year. That would get us right into a target. But I think the setup here is for, maybe even better. I'm not saying this is our call. I'm just saying it. This is just my personal opinion. Look, what do we have? Huge amount of rate cuts priced in for next year. That's potentially going to boost cyclical activity, especially housing. You just talk about like home equity. Think of how much of home equity can be pulled if mortgage rates fall to even 5%. That is just massive. A mind-boggling amount of money that can be spent on all sorts of things, remodeling kitchens, all sorts of things, right?
Yeah.
And then you have deficit spending. We can talk about tariffs, and maybe the tariffs will be, a big chunk of the tariffs will be ruled illegal by the Supreme Court. We don't know that yet. But either way, the tariff uncertainty is going to come down. I think it's already coming down. So that's a second tailwind, right? And then you have deficit spending, you have tax cuts and all of that. At the beginning of next year, a lot of people, especially, more wealthy people who itemize their taxes, for example, they're going to get a bigger deduction because state and local taxes, property taxes can be deducted to a higher degree. Again, that's more money for consumption, right? These are massive tailwinds for the economy. And I think, okay, personal opinion, I wouldn't be surprised if we end the year up 20%, if not 25%.
Right.
Again, personal opinion.
And that would be 3 years in a row of up 20%, which sounds kind of crazy until you look at the late 90s and you realize there were 5 consecutive
That's the other
years
thing.
we
By
were
the way,
up that much.
late 90s, we had all that, the tech thing. And we just had NVIDIA earnings, right, Ryan? We have the AI FOMO going on. Like, they're spending on CapEx, so we need to spend as well.
Yeah, well said. So, I believe I'm going to say correctly, Green Day, wake me when September ends. So we can put up now, September is the worst month of the year. As you've probably heard, David, that chart with all the pretty colors. As you probably have heard, September is the worst month of the year. Now, listen, we get it. August didn't really play out. Just interestingly, August had never been higher with a second-term president. Now, it's only sample size of 5, so obviously we're higher. But one thing that happened was the Fed turned obviously much more dovish at Jackson Hole, sparking that rally. But still, let's not ignore the fact that September is the worst month. Again, as we're showing on YouTube, the worst month is 1950, the worst month the last 10 years, the worst month the last 20 years, and the third worst month in a post-election year. So those are things to think about. Now, one that got me, this is the next chart, David, that I sent you we can share. When you have a really good August, now, by really good, I was thinking, what is a really good August? Well, first off, it's positive, but also some new highs, right? It's making some new highs. So get people feeling good. So I found 1, 2, 3, 4, 5, 6, 7, 8. I thought it was 8. 8 other times. The August for the S&P was up at least 1%, so a good month and a normally weak month, but 5 or more all-time highs during the month. So you're up on the month, you're making new highs. Everybody's probably feeling good. The next month, which is September, has never been higher. So I don't know. I mean, that's just sample size, whatever. But never been higher. Talking lower. So could there be some weakness? One thing that worries, maybe I'd love one worry of yours, Sonu, because we are still bullish, but one worry of mine, and the worry, I'm putting this lightly, is some of the tech leadership is starting to go away a little bit. We had NVIDIA down 0.8% the day after earnings. What a relief. Down 3.5% on Friday and down another couple percent the time we're recording this. Tech is looking a little top heavy, not the end of the world, but NVIDIA makes up, I think, 8% of the S&P 500. Yeah. So listen, now that's where the beauty of the equal weight S&P comes in, because you look at the equal weight, the market's doing just fine, but some of the top heavy parts, specifically technology, look at a relative strength, it's starting to break down, it's getting real geeky in everybody. A head and shoulders potential top on the ETF for technology. I'm not saying, you should always go in this stuff, but I do have some near-term worries. It's September. Maybe tech pulls back, and maybe something like energy, which nobody owns. It's super duper small. Maybe that bounces a little bit. And again, it's like, well, if you owned all the stocks equally, it's not that big a deal. But that's one thing that gets me. September, maybe we have a little rockiness. It's starting off a little rocky here. What's a worry of yours, Sonu? Because I know you're bullish. We'll get into that. But what's a worry you have, at least let's say for the next, 6 weeks, which is a seasonally dicey period, I guess we'll call it?
I could easily see the sequence of events happening. The payroll report for August comes out okay. Let's say the unemployment rate remains at 4.2, 4.1%, 100,000 jobs created. Yep. So it's okay. It's not if it's gangbusters, that's even, even better, right?
Yeah.
But it's not really weak, right? We don't see huge revisions, things like that. And then,
by the way, could you imagine if we had huge revisions again? I mean,
that could totally happen now.
We might need to do an emergency podcast, because whatever President Trump does, it's going to be worth talking about in real time.
I am actually going to be in your neck of the woods in Ohio this Friday.
You guys come in Friday for the Buckeye game?
For the Buckeye game to watch Ohio. How about the Texas victory? Huh? I thought you would be celebrating.
Everybody said Ohio State had no chance. Everybody said Arch Manning apparently walks on water, but apparently he can't throw a football football to an open receiver, which is important when you are a quarterback. But we'll just leave it there. I had to do it. I love Texas. I love the state of Texas. I got some buddies who are Texas fans too, so that was for them.
So me and the kids will be at the Buckeye game this Saturday.
Awesome.
For that, and then on Sunday I get to see you. So
there we go. That's
there
true. Sunday. Wow. Sunday. It's just weird. We're flying out to Arizona for our, I believe it's the 40th. I think I should know this. I think it's 40th, 40th Excel, which is a great time to get together with all of our amazing Carson partners. I think we've got like over 1,000 people coming. I think, don't quote me here, but all of our partners and it's just going to be a great time. I know you and I are doing some live facts versus feelings. Maybe I won't give it away quite yet, but we've got a huge name on stage. And again, it's on the website. It's public. Dr. David Kelly, whatever. This is public. It's on our website. We have Dr. David Kelly in front of everybody. We'll record that. We're recording some other, maybe we'll save the other one, some other big names as well. But we're pumped to be on stage with Dr. David Kelly over at JP Morgan, I guess in not that far away. Like not that far away. A week from now. Yeah. A week from I think we're on stage Wednesday. So we got 8 days. I think it's you think we know when it is. It's sometime when we're out there.
It's on our calendars, hopefully.
Tell us when and where. Yeah, we'll be there.
So what are you talking about? Oh yeah, okay, the sequencing. What could go wrong in September, from my perspective? We get a fairly strongish, maybe okay payroll report. And then on the 12th, next week, we get a CPI report that is pretty hot.
Okay.
So we got okay payrolls. We got hot CPI. I think then September cut is up in the air.
Wow.
I think we go to maybe 60-40. It's not a certainty. Definitely. I already don't think it's a complete lock. But going into the meeting, that's going to be the quiet period. The quiet period means that's when Fed governors, regional Fed presidents, they're not out there talking about what they think should happen at the next meeting or with policy. So it's a quiet period. And then maybe we get an article in the Wall Street Journal with Nick Timmeros or something,
Mr. Timmeros,
telling us what could happen. But I think in that scenario, we could be set up for real volatility. And goodness, imagine they don't cut, Ryan. I think the market just goes like, oh my God, what are we even doing here, right? But hear me out. This is why I think September is sort of, irrelevant at this point. We don't have to spend too much time talking about Lisa Cook and that whole, kerfuffle, the president trying to get rid of Lisa Cook because what happened to the mortgage statement, whatever, right? But the big picture, he's trying to get rid of, he's trying to create the Fed governorship in his own image. He wants his people on there. Right now, he's got 2 of them, maybe. Michelle Baumann, Chris Waller. He's going to get a third, Stephen Moran, coming from the Council of Economic Advisors. So he's got 3. There are 7 total. The 4 others, let's say Powell quits next May, right? I don't know if that's a certainty, but let's say he goes. If Lisa Cook is gone, Trump gets a majority, right? And here's the other thing that happened. Every 5 years, and I didn't know about this, Ryan. Every 5 years, the 7 governors have to vote for the yes or no for the full slate of regional Fed governors. There are 12 regional Fed governors. Every 5 years, ending with 1 and 6, 2021, 2026, they have to say, okay, yes, we vote for all of them to stay, or we are not. Get some new ones in, right? That vote is next March 2026, right? Wow. So if Trump gets his people on the Fed, a majority, the entire slate of Fed presidents could be, removed. Maybe his own people come in. And there's a reason why I think the market's pricing in a whole bunch of rate cuts next year.
So let's dive into that because, you turn on TV and you see what they're talking about. Short-term rates, like 2-year yields, obviously are dropping. The 10-year yield in the U.S. is kind of going sideways. But longer, 30 years going higher. But globally, we're seeing longer yields going higher. This creates what we call a steepening yield curve. Now, Sonu, you know this way more than I do. I grew up hearing the steepening yield curve meant 2 things. Either the economy is going to get stronger or there's expected higher inflation coming, which kind of feel like two way different things. Am I on track there? And is the global steepening yield curves, and by the way, I wrote it down. Give me a second here. Oh, I should have it. All the different countries that are having steepening yield curves.
Japan, there's France.
Well, I wrote them all down. Here we go. U.S., U.K., Canada, Japan, Germany, Switzerland, Australia, and New Zealand. There's probably more, but I saw a nice chart. I believe it's 8 of them. All 8 have steepening yield curves, and it's all happening, recently, right? Recently, as in like a lot of this stuff you just talked about, trying to transform the Fed in essence, which again, it's a gray area here. It's supposed to not be, political. What's your take on the steepening yield curves, first off?
So if you think about the steepening yield curve, what's happening? Let's say you're 10 or 30 year, let's take the extreme, like 30-year yields on your sovereign government bonds versus minus what's happening on the short end, let's say 1 year or 2 year, right? Now, the 1 year and 2 year is pretty much reflective of what the Fed is going to do, or what the Fed's expected to do, or what the central bank in these countries is expected to do over the first, over the next 1 or 2 years. So what are the rest of the global central banks doing? Right now, they're easing, except for the Fed. Everyone's easing. So by itself, forget, let's say the long end stays steady. Let's say the 30-year doesn't move at all, right? Just by the fact that they're easing, they expect it to ease, that should make the curve steeper, period, right? So you get that. Now you think, why are they easing? Well, because in those countries, they don't think inflation is a problem. I don't think inflation is a big problem. We'll talk about the US side. I think it's a little different here. Yeah. But then you think about, why is it? But the long end is also going up. That's the other side. So you're getting a double whammy, right? Short end rates are coming down because central banks are expected to cut, and they are already cutting, the European Central Bank, things like that. And then you think about the long end is steepening, to your point about it steepens because of, it goes up for two reasons. One is higher expected growth or higher inflation. It could be both.
It could be both.
Exactly. It could be both. In the US, I think I'm probably one of the few people who think we could get both. We could get inflationary growth next year. I don't think we get stagflation where growth is falling off a cliff and we get inflation. I don't think we are in a stagnant flight. I mean, we may get 2% growth with inflation. That's not recessionary. That's not stagflationary.
So you're not the only one, because the price of gold is up 8 months in a row, which going back to the late 60s, that's the longest monthly win streak in the history, at least go back to the late 60s with spot gold price in US dollars. So again, we've laid out for a long time now why we like gold. Just several weeks ago, you wrote 2 incredible blogs, carsongroup.com/research. You can search under Sonu's name and find them quickly. Why we still like gold. We added gold to our longer term strategic models. Think 3 to 5 years, probably almost a month ago now, Sonu, 5 weeks ago.
Five, six, something
back
like
when,
that.
Back when gold was going sideways, because I'm a fairly simple person. I said go up a whole bunch, and then it went sideways for like 3 or 4 months. I said, that is beautiful. Okay. It's just, there's 2 ways to kind of catch your breath: through price and through like a downward move, or through consolidation, right? Through time, in essence. And to me, gold was correcting through time, just catching its breath, going sideways, showing strong relative strength. The dollar had a little bit of a pop, whatever happened. But now we're on the other side of it, and it's not a surprise at all to me to see gold above $3,500 an ounce, and probably going a good deal higher. The good news is the stock market's hanging in there, but as we've laid out, having some gold exposure, having some managed futures, maybe some different commodity exposure in this uncertain time that we're in makes a lot of sense. When we had JC, last comment here, we had JC Pretz on a few weeks ago. JC pointed out, I never thought of it like this, but he's so right. If you think gold's in a bull market, do you think it's going to end right now? Because if it did, it'd be the shortest bull market gold's ever seen. Usually these bull markets last many years. This one's been a couple years into it. And, I thought that was an interesting takeaway from JC. What do you think about gold? Want to talk about, Sonu means what, by the way? What does the name Sonu mean? Yeah, gold.
Sona is gold. Sonu comes out from that. So, but look, don't ever ask me what I think of gold. No, I was kidding, right? And it's only recently, I should say, we added a strategic portfolios. We've had it in tactical models since, like 2.5 years now, right? So I feel like we talked about it when we did our first few episodes of Facts versus Feelings. 151 episodes ago.
When we first brought it up, we got some weird looks, by the way. The SVB crisis, we thought gold made sense to have a little bit in there in our tactical models, and thank goodness we did, because clearly gold has outperformed bonds in a big way.
Gold ties in nicely to everything we're talking about. We just talked about the Fed. We talk about, steepening yield curves. Part of the reason central banks across the well-developed markets are easing. And at the same time, inflation's not really low. In the 2010s, everyone was easing and inflation is low. At this point, inflation's not really low. Now, in other countries, I think it's closer to target. But then you're also seeing fiscal reflation, right? We've talked about in the podcast before, Germany doing a lot more fiscal spending. China could be doing that. Japan's thinking about that. And we'll see where rubber hits the road will they actually do it? But I think that's happening, right? So then why gold, right? Our thesis for gold is, look, I don't want to say it's very simple, but a few points, right? Inflation will be volatile going forward. This doesn't mean average inflation, say in the US, will be, 5% or anything like that. We'll just see more surges of inflation every now and then. I think gold is a good hedge for that. The Fed, over the long term, will have to keep rates on the higher side. let's say over the next 4, 5, 6 years to keep inflation closer to their target, right? And now over the next year, I do think we get a reflationary boom because it's going to be a Trump Fed, and I think they cut, right? It's not a certainty, but I think the odds are in favor for that. But because inflation's volatile and the Fed will have to keep rates on the higher side over the next several years, I don't think bonds work as well as a diversifier. The correlation between stocks and bonds, which means if stocks go down, usually expect bonds to do, if stocks zig, you expect bonds to zag and opposite, right? But I don't think that works, as well as it did from 2000 to 2020, which means you need another diversifier, and gold fits that bill quite nicely. And then finally, speaking of bill, pun intended, look, we've been agnostic on U.S. versus international growth prospects. We're neutral, right? U.S. equities, international equities, you and I have talked about, including with JC when he had him on, about a global bull market. So we're not underweight the U.S. We are not overweight international either. But the other thing is, given our strategic long-term views, we don't want to be overexposed to the dollar. What's the easiest way not to be overexposed to the dollar? Go buy other currencies in the world, right? Buy euros, yens, whatever. But we don't want to do that either because we don't want to because there's risk out there, right? So what's the best currency diversifier? Gold. I think that's essentially, our thesis for it.
No, well said. From 99 to 2011, when gold went up like every single year, had a major peak in 2011. What did much better from a stock market point of view? Well, it was developed international, right? Now, we're not saying that's going to history and repeat, it often rhymes. So again, we like the U.S., yes, but why having a little bit more international than when we started this podcast 151 weeks ago or a year or two ago? We've obviously changed, and you obviously spearheaded this, Sonu, back in, I guess, February or March.
8 months ago, right? Yeah, it's 6 to 8 months ago.
Yeah, I mean, when you pointed out, listen, what Germany is doing here with all this stimulus that they are going to do, this time is different. Sir John Templeton, foremost dangerous words, but it really was different. And you said there's some things going on here in Europe that make us think maybe there can be an outperformance, and my goodness, has there been. I know we want to talk about PCE, but let's mix it up for a second. There was some data that came out, friends over at Morningstar. You didn't see this coming. This is the joy of a live podcast. I just fire away and see what you think. 4,300 ETFs versus 4,200 stocks. There are now more ETFs than stocks. I'm sure you've had a little time to think about it. I've got some thoughts too. Obviously, it caught a lot of people, I don't know if off guard, because I guess we saw this coming, but at the same time, I don't know. It is eye-opening to think that there are now more ETFs than there are U.S.-based stocks. Do you have any immediate thoughts on this fun conversation without getting us in trouble?
I'm just going to quote a friend, and I'm going to do a bad job of, I'll just paraphrase what he said. A friend, Sam Rowe.
Yeah.
There are more recipes than there are ingredients. But it's like, look, I have eggs in my fridge, right? Just eggs. I can make poached eggs. I can make, scrambled eggs. I can make omelets, all sorts of things. Hard-boiled eggs, soft-boiled eggs. I don't like those. I'm a scrambled egg person myself. Once in a while, I like an omelet.
Yeah.
But then you think about, okay, say I have some tomatoes, onions, and mushrooms. Now I can do a lot more. So again, I think Sam captures it really well. Sam's a genius when it comes to this stuff. Like, there are more recipes than the ingredients. And so I'm not surprised that given 3,000 stocks, 4,000 stocks, you should expect. I mean, goodness, we have like 15,000 mutual funds, right?
Well, that was what I was going to say. There were literally like 9,000 mutual funds.
9,000, right.
At the time in the early 90s, like in the early 8,000 mutual funds in the early 90s. I think we have more now, but exactly. Eric Balchunas over at Bloomberg, he said along the same lines as Sam. I liked this one too, and you would know this as a musician yourself with the guitar. There are 12 notes, yet 100 million songs.
There you go.
So I thought that was pretty good by Eric there. Now, a couple other things. The SPY, the SPY, was kind of the granddaddy of them all, if you will. The ETF, S&P 500 ETF, came out 30 years ago, and that kickstarted obviously a huge move in ETFs. It's estimated there's about $12 trillion with a T in ETFs. It almost feels like it's not slowing down. A couple more stats, if I can find it here. Here it is. So this point of the year, there have been 469 ETFs that have come out. That's 50% higher than the year before pace and 140% higher than 5 years ago. It does feel like everybody has an ETF. Honestly, I'd love to have an ETF with you. Facts versus feelings. We've talked about it. Like everybody has. Most of our guests, it feels like Tom Lee, Dan Ives. Everybody's got an ETF.
Put in comments on our YouTube channel if you're for it. Like, what do you think?
That's true. That's true. On YouTube, you can do comments, and it helps the algorithm, so let us know. But I mean, I don't have the answer here. I mean, I just thought that was interesting. It caught everyone's attention.
Such a good point. I mean, there's demand for this stuff, and like this year especially, I wonder how much. Maybe you can ask Eric when you talk to him. But out of the 469 ETFs that were launched this year, a big chunk of them seem to have been like single stock ETFs, and then double leveraged and triple leveraged. And again, none of this is a recommendation, by the way. But here's an ETF that invests 2x Tesla or 3x Tesla, things like that, or 2x NVIDIA. Can you imagine that?
No. Yeah, I am on with Eric Walchunas actually a little bit later on Bloomberg today. So thanks, Eric. And we give shout out because I should have done this. It was Bespoke. You pointed it out. 469 ETFs this year, 50% higher than last year, 140 than 5 years ago. That's from our friends over at Bespoke. All right, so that's kind of interesting. Do you think it's time to go to the PCE? I tried to break it up before we dove in here. It's like it's trying to stay away from it. I don't know.
Before we put everyone to sleep. No, hopefully we won't put it. No, I think. Look, let's go there. We already talked about the Fed, but I think it ties into what's happening, and then it ties into the reflate global yield curve steepening thing, gold. There's a reason why gold is suddenly breaking out, and it didn't break out all this time, right? Gold's broken out over the last 4 or 5 days, something like that. It's something
just recently. Yeah, it went sideways for a while, but just recently. Yeah.
Right. I don't think these things are a coincidence, right? What's happening with Trump wanting control of the Fed, and you can agree with it or not. Like, I'm not even getting into that. It is what it is. My job is to see what is happening, what may happen in the future, right? Yeah. I have my own, my biases, political biases, but set that aside, right? What we have to do is it is what it is. And what it is right now is that Trump basically wants control of the Fed. But then that gets into the inflation picture, right? The Fed's pricing in 6 cuts, or the markets are pricing in 6 cuts over the next 16 months. Let's call it 16 months.
Right. So you talk about PCE and let's start there. PCE.
Core PCE, right? Core PCE came at 0.27% month over month in July. And if you annualize that, that's 3.3%, right? Okay. So we're still well above target. But 1 month is noisy. So let's take the last 3 months. That's 3% annualized. Last 12 months, 2.9%. 2.9% year over year for core PCE is the fastest pace since April of 2024. Right. So we're talking about 15, 16 months or so. And then you think, okay, where's the heat? Now, up until last year, we could have said the heat is in 2 places: housing and financial services. Financial services, portfolio management services. It's stuff we do because the stock market's up. Financial advisors are charging more, right? So that's simple. But that's not where the heat is coming from. We got heat from 2 places. One is durable goods, and the tariff impact is showing up in durable goods inflation. Durable goods inflation is running about 1.5% annualized over the last 3 months. And you think about that, that's not huge, right? And you think about the tariff impact. You and I have, again, talked about this. It should be one-off, right? And the problem is it may not show up all at once. And Powell talked about this. But what's striking is that, if we didn't have the tariffs, durable goods inflation would be going down. In fact, we would be getting deflation. Prices would be going down, right? So the swing from going down to now going up is big. That's where some of the heat is coming from. But look, I buy the fact. I'm in the camp that I think, tariff inflation will be one-off. After some time, it's going to go away. So you look past that. In fact, Fed Governor Chris Waller just said he's back on team transitory, Ryan. So I don't
get your T-shirts now. Yeah.
He's back on team transitory because he thinks, look, the recent upward move in inflation is temporary. But that would be fine if all that recent upward move in inflation was coming from goods, but it's also coming from services. Services, I think, is a problem.
So let me jump in. We can get to services. Another thing that doesn't think inflation might be quite as transitory, and I know probably the camp you're in, tips are outperforming zeros. If you look at like a relative strength, it's kind of one of those, what's the market telling us?
And tips are treasury inflation.
Treasury inflation, right. And zeros, are very volatile, right? They're,
zero coupon long-term bonds.
Zero coupon long-term bond, yes. But the bottom line is to see tips outperforming zeros by a good margin on a relative basis. It's kind of the market's way of saying maybe there could be a little bit more inflation coming out into the future. So it's just something to think about there.
And it's coming out in the data too. So if you look at core services, right, and take out housing, we know housing's normalized finally about time after like 2 or 3 years of talking about how housing is lagged. Housing's normalized. But Then you look at core services, ex housing, it rose 0.4% in July. If you annualize that, that's a 4.7% annualized pace. Last 3 months, 3%. Last 12 months, 3.3%. Now you think, okay, what do those numbers mean? What's normal, right? You take 2018, 2019, it was running at 2.2%. We are well above that. And core services, ex housing, I know, sometimes those of us who dig through the data can get accused of, hey, you can't throw out energy and shelter and food and things like that. That's what most of us spend our money on. But still, core services makes up a good chunk of the inflation basket. It's got like pet services, dental services, all sorts of things, dry cleaning. It makes up over 50% of the PCE inflation basket. So it matters, right? And right now it's running at least 1 percentage point higher relative to normal, let's say 2018, 2019 inflation. I think that's a problem.
So great stuff. I mean, I did see super core, which again takes away that services PCE, X housing and energy continues to be firm. Here's my question. If you take out housing and energy, what in the world is left? What is left on that services side? It's
basically restaurant spending, like the stuff. Okay. So in PCE, what's interesting is restaurant spending is included in core, whereas in CPI, restaurant spending is like food. So it's taken out from core. So whereas in PC, so when he's looking at super core, it's included in there. But then it's all the other stuff I mentioned, right? It's got, internet services, wireless services, dental services, pet services, your vets, things like that, right? It's got all of this stuff. That's essentially what you're talking about, core services, X housing. And like I said, this is, it's important because it makes up, over 50% of that PCE basket, right? And sometimes you think, wait a minute, is it like one or two categories pushing those things higher? And we have experience with that, right? Like used cars, for example, it makes up only 2-3% of CPI PCE, but used cars is a big problem. Car insurance is a big problem last year too. But what I looked at
tell me about it. I've got a 16-year-old. It is, and I've got 2 boys that are coming up. It is a big problem. That is true.
Absolutely. Yeah. So what I did is, okay, is there another way to look at, is there any real heat or is it because of one-off things, right? So what I did is I took that core PCE basket. There are 178 items, Ryan, that make up that core PCE basket.
By the way, I mentioned this live on CNBC on Friday with Judge. Okay. I mentioned 178 components of core PCE. Yeah. Shout out to you. So thank you.
So thank you for that.
I think I put everybody to sleep with it, but I thought it was good content.
No, and I calculated the distribution out of these 178 items, look at year-over-year inflation for all of them, and look at 4 different periods, right? December 2019, June 2022, when inflation peaked, in December 2024, end of last year, and then July, what the data which we just got, right? In December 2019, 24% of items, Ryan, had inflation rates above 3%. So that's your baseline. That's normal, right? And David, you can put this chart up. When inflation peaked in June of 2022, when we had like 9% CPI inflation, 72% of items had inflation rates above 3%. But then over the 2.5 years after that, June 2022 to December 2024, by the time we got to the end of last year, that fell to just 40% of items had inflation rates above 3%. Again, before the pandemic, it was 24%. Now, at the end of last year, we were at 40%. Fast forward 7 months into this year, inflation's broadened out again. And now 45% of items had inflation rates above 3%, right? And the numbers actually look worse if you look at, that was core PC. If you take out goods and housing, and if you just look at core services, it shows even more broadly.
Wow. Okay. So does that mean you wouldn't be team transitory? But what does that mean? What does that mean to you, though, when you put all this together?
Look, if the inflation pickup, if the pickup of inflation was just coming from goods, I would say, okay, I'm team transitory.
Got it.
But right now it's coming from services as well.
And one thing you pointed out, I think maybe a week or two ago probably on this podcast, but the sticky inflation. I believe it's a Cleveland Fed or Atlanta Fed, one or the other. I always get it mixed up, but they come look at the sticky stuff. So stuff that shouldn't change. I always think like, if you go to I don't know anyone does this, but you go wash your clothes, put those quarters in, like those prices usually don't change very often. But the sticky inflation has been starting to trend a little higher. In late 2021, early 2022, we saw that, and it was almost ignored or brushed aside. That's just one thing. But with sticky inflation going up, the broadening out inflation. I guess the bottom line is there's a little more inflation. You probably want to own some hard assets. You still want to own some stocks. Stocks historically do well. And you maybe don't want to have as many bonds. We have bond exposure. I'm not minimizing it, but maybe, again, there's other things that do better from a diversified portfolio. Is that kind of how you'd sum it up?
Yeah. Look, the big picture is I think the Fed's got an inflation problem. It's coming from two sources. One may be transitory. That's durable goods. And, David, you can put this chart up, PCE price index, durable goods and services. There are two charts in there. Durable goods, I think it's up 1.1% year over year as of July. By the way, that's higher than anything we saw from 1996 to 2020, 25 years. So it's still higher than that, right? Now, I can, and I probably will argue that's transitory. Okay, fine, right? But then you look at PCE of services. That's running at 3.6% year over year, and it's stuck there. And the average from 1996 to 2020 was 2.5%, right? So we're well above that. I think that's very problematic. But Ryan, as I said, the market's expecting 6 rate cuts over the next 16 months. So inflation's elevated. Market's expecting a lot of rate cuts. I mean, how could that not be bullish? I don't know. You tell me. I feel like that's very bullish.
Yeah, I feel like we listed some potential concerns and worries in this podcast, which is good. We always want to show that, but the overlying weight of evidence to us still says this is a global bull market. Still says stocks going to do well. I think gold keeps doing. I've been a broken record for 3 years saying, listen, gold and stocks can go higher together. We've said that for a while. People are starting to catch on. Oh, they can go higher together. Yes, just go back and look in history. They absolutely can go higher together, and that's kind of where we are. And maybe commodities. I mean, what is it? Silver. Silver's above $40 an ounce, right? I mean, highest level, I think, since 2011. So you've got some different commodities doing well. We've gone long enough.
How much time do we have? I have a question for you, though.
I mean, I don't know. We could go all day, but let's try to make it 5 minutes, I guess.
Yeah, let's do 5 minutes. But I have a question for you. It seems like everyone's turning bullish. Now we've had, and maybe it's because, May has been positive, June's been positive, July, and then August too, right? August tends to be iffy. Yeah. August is positive, and I think the last bear on Wall Street from Evercore or somewhere, I don't know.
I was going to bring that up. Yeah, I've got the tweet. I'm literally pulling up my tweet.
I need to ask Ryan how he feels about this, right?
No, I don't like it. But after a 30% rally, after everyone promised us a recession this time 4 months ago, and we pushed back against that. I think we're probably due for a little bit of consolidation, little bit of I don't think it'd be more than 4 to 6%. We're going to blame it on President Trump trying to do the Fed and the Powell and this and that. But our friend Josh Schaefer, formerly of Yahoo, I know he's leaving Yahoo, going to Bloomberg. So congrats on that move, Josh.
I didn't know that.
So there you go.
Josh.
Yeah, he noted this. Let's read his tweet. He said, one of the last bears on Wall Street has flipped. Evercore's Julian Emanuel raised his 2025 target from let's see here, from 5,600 to 6,250, and he sees 7,750 by the end of next year.
Wait.
And it turned into a huge AI bull. Go ahead.
6,250. He changed. That's his target for 2025, is it?
I guess so. Yeah. So it's still not too high.
So he thinks the market will fall from here.
I guess he finally said, I can't take it anymore. But then 7,750 through the end of 2026. And a big part of that is an AI. Oh, actually, he calls it an AI-driven asset bubble. So he even calls it a bubble. So he's you can tell he hated doing this. Hated doing this. There was a target below. But anyway, we're seeing those things again. My bigger near-term worry is some of the large cap tech potential weakness. We're starting to see some things break down. Not the end of the world. Like other groups will probably take the baton. But again, just from a purely, there's a lot of big cap tech out there. Maybe it's due for a little bit of a break. I mean, NVIDIA had amazing earnings once again, but hey, maybe it's just due for a little bit.
Do you think the same applies to gold as well? Like, do you see sentiment changing on gold with more people saying,
no, I feel like it's easier for a lot
more bear to bull conversions in the equity market than bear to bull conversions for gold.
Yes.
I don't know. But you follow this stuff more closely.
Well, Tim Haynes over at Ned Davis Research just had a note on that this morning, literally talking about the fact that gold is breaking out the new highs and no one seems to care. I mean, literally, like nobody cares. Like, I'm not hearing from anybody about gold. Are you? Okay. I mean, sometimes you get those indicators. I said on this very podcast, people I was hearing from on April 9th, 100 years ago, 100 trading days ago, right now, man, 100 years. I mean, well, the psychology is probably the same 100 years ago, but people I never hear from know what I do. Said, oh my goodness, Trump's a moron. He's going to wreck everything, sell everything. I just said, well, listen, I'm not giving you a comment on the first one, but I'm telling you the second one is don't sell everything. I mean, like that's the way I answered that. And sure enough, here we are. But with gold, we're simply not, I'm not seeing flows and different things. We still, I mean, again, another stat, I'm going to try to remember it off the top of my head here. Gold is like $24 trillion, the market cap. Bitcoin's like $2.5 trillion. So Bitcoin is like 10%. But if you look at the ETF flows to those Bitcoin ETFs versus GLD, it's almost caught up. Like literally there's almost as much money in this. So what I'm getting at, even though gold has outperformed Bitcoin so far this year and is breaking out, whereas Bitcoin potentially is breaking down, we're not seeing a lot of excitement toward gold right now, which again continues to think it's an asset you probably should have a little bit of in your overall diversified portfolio.
I won't complain.
Yeah, it's your name. It's your name. You don't want your name to be, you don't want your name to be like, I don't want someone to ruin the name Ryan. I mean, I don't know who would, but yeah, it's
there you go.
All right. So this week is, we got jobs. We talked about it. Things are calming down. Earnings season, put a bow on it. It's been really strong, led by, honestly, the Mag 7, really strong earnings from the Mag 7. But next week we're in Arizona. Which again is the 40th Excel. I believe it's my fourth one. I think my 2, 3, 4. Yeah, this is my fourth Excel. How about that? Yeah.
Wow.
We started this podcast literally at Excel back in Vegas, out in Vegas. Yeah, 2022. What are you looking forward to at Excel as we get to hang out with all of our amazing Carson partners and different industry leaders and thought leaders and just have lots of fun at a really nice looking, I won't say where, probably just not supposed to say, but heck, it's on the public website. Well, we're going to a nice resort. We're going to a very nice resort in Arizona. Worst place to hang out. That's just how they do
these things, right? Like, they wouldn't do it in a, crappy place.
I wouldn't go. I'm teasing. I go where you send me.
No, you said it. I think I'm looking forward to getting together with all our partners, advisors. I mean, always like, oh, I'll have time for this. I'll have time to catch up with Ryan and other members of the team. Barry's going to be there. Jessica's going to be there. Grant's going to be there. Like, and it's always like, oh yeah, I'll get some time to see them because I work remotely, just like you, and it's not often I get to catch up. But then most of your time is spent talking to advisors, and somehow I know it's probably the same for you, but I get sort of energized by that, so it's kind of cool. To get the feedback, and most of the time they just want our views and say, Sonu, Ryan, we like what you do, keep doing it, and we love what we do as well. So I'm looking forward to that. And
you summed it up. I know Michael Phelps is going to be there. I'd like to challenge him to a swimming competition. I don't know if he'll take that, but he's on Tuesday. You and I are on Wednesday on the main stage. I was hoping he'd be backstage when we were, just to get like a picture or do a quick video. If he'd let us do it, it's probably in the contract. Probably get myself in trouble. But anyway, so hey, we've got a podcast. But
speaking of podcasts and guests, next week's episode will be with we'll have two guests on, and I think we can give up the name.
Yeah, sure. Why not? Yeah, sure.
Yeah. We have Sam Rhines from Wisdom Tree. Sam is amazing, in terms of thinking about the macroeconomic picture and especially even global, right? And then he's into stuff like farmland and all sort of things. So I'm excited about talking to him about that. But then we have Strider Ellis from First Trust. And just the name is cool because one of my favorite books is Lord of the Rings. So I know I want to chat with him about the background behind his name, Strider, too.
Oh, boy. Yeah, I've done some events with Strider over the years. You just cross paths. He's awesome. I've never met Sam, but you've spoken very highly of him. So anyway, so that'll be a live thing we're going to do next Monday out in Arizona in front of our partners, and we're going to record it, and it'll be the podcast for next week. So again, if the idea of being at a really cool company, if you're a financial advisor, you need some help. And the way Bert White, our CEO, puts it, if you kind of lost your love for your job, lost a love for what you're doing, check us out, carsongroup.com. There's different things that we can, and you get to work with Sonu and I. If you think we give away a lot of this podcast, you can only imagine if you actually come here, what all the different things that our team, just from we're the research guys, just from a research point of view, the things we do. But Carson Group, there's a reason we're growing like we are. So many advisors want to join up. We're going to have a lot of fun with everybody out in Arizona. If you'd like to come to the next, actually, I don't know if there are more Excels, but if you want to come to any more events with Carson Group, you got to join up. So carsongroup.com, I know we'd like to talk to you about that. With all of that, again, this is is episode 151 of Carson's Facts versus Feelings. We called it September Blues? Yep, September Blues. Day one. There's a little red out there, a little blue out there, but we'll see.
I see a headline saying stocks sink, yields jump amid tariff and Fed uncertainty.
Yeah, my take
headline
is
may change by the end of the day.
I mean, that's a very cookie cutter. My take is stocks are up 30%. Maybe it's just time for a little break. I mean, that'd be my take, push back against that. But hey, you got to make a headline. You got to make it kind of sound scary, and you got to click on it right away. So, of course, I've always made the joke, there's always uncertainty. Every year has uncertainty. When there's no uncertainty, that's when you want to sell. I like hearing uncertainty. Anyway, all right, we probably went a little bit long, but thanks everyone for listening. Please give us your likes, give us your follows, give us your comments on that YouTube channel. Those things go a long way with the algorithm. We really appreciate that. We've hit some huge downloads and listens consistently the last 2 months or so since you and I went to New York City with Josh and Michael Batnick, and that's really helped momentum. So hopefully by now people are probably dropping off or not. So hopefully people are staying. Those new listeners that we got from that bump when we went to New York City. With all that, to everybody, enjoy your week. School is here, football is here, September is here, and we'll be back next week with some really good guests to break it all down. Take care, everyone. Thank you.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM, LLC, or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM, LLC.